Nightcap. I'm Daniel.
And I'm Mira.
So today, the U.S. oil market basically looked at empty barrels, a hawkish Federal Reserve, and a global supply crunch. And, well, decided to just laugh it off.
Yeah, completely brushed it off. Welcome to the deep dive, everyone. We are unpacking a pretty wild day where that proverbial watched pot of the Strait of Hormuz finally boiled over.
Right, but not into a wider war, which is what people feared.
Exactly. It turned into a massive diplomatic breakthrough instead, which triggered this huge oil sell-off and a really fierce tech rally.
It was a day where forward-looking relief just completely overpowered all the backward-looking data. So here's our roadmap for you today.
Yep.
First, we will unpack the overnight geopolitical shifts that kind of set the stage. Then we are diving into that massive U.S. session intraday reversal.
Yeah, that reversal was wild.
Yeah, it really was. And finally, we will break down the corporate AI spending spree that is, acting as the fundamental anchor keeping equities afloat right now.
But before we get into the weeds, just a quick reminder that this briefing is strictly for market context and discussion. It is not personal investment advice or, an investment recommendation.
Right. So let's ask our first big question of the day. Session 1, what set the stage before the U.S. session?
To really grasp the magnitude of today's explosive equity move, you have to look at the severe carryover anxiety from Tuesday's prior session.
Yeah, heading into Wednesday morning, the global macroeconomic mood was just incredibly tense.
Super tense. I mean, you had European central bank officials practically threatening a June rate hike because of the global oil shock.
And it wasn't just the ECB making noise, right?
No, not at all. Overnight, at 2 a.m. Eastern Time, the United Kingdom reported sticky consumer price index inflation at 2.8%.
Oof. And for anyone tracking global macro, you know that sticky CPI is the exact kind of inflation that keeps central bankers awake at night.
Exactly. It means core services and wages are just refusing to budge. And on top of that, Bank of England officials were actively warning that they would act forcefully if these energy disruptions worsened.
Right, so global markets were genuinely sweating a synchronized wave of global rate hikes.
Which is precisely why we really have to challenge that reflex to view the Middle East conflict as some kind of unpredictable natural disaster.
Yeah, it's easy to just watch the news and think of geopolitics like a hurricane. Just tracking the chaos and trying to price in the damage.
But if we look at this through the lens of geopolitical escalation as brinkmanship game theory, what we were seeing over the last few weeks wasn't random chaos at all.
No, it was calculated.
Very calculated, Daniel. It was rational actors pushing the situation to the absolute edge to maximize their leverage and then, stepping back to the negotiating table.
And that framework played out perfectly today, because right on cue, mediators revealed they are drafting a formal letter of intent for the U.S. and Iran to end hostilities.
Yeah, and launch a 30-day negotiation period. The specific catalysts here show exactly how that brinkmanship unwinds into structured de-escalation.
Right, because Iran essentially outlined a controlled maritime zone in the Strait of Hormuz.
Exactly, laying down clear rules for how commercial transit could resume. And by establishing rules of engagement, you basically remove the unknown risk that markets just hate the most.
Absolutely. And on the other side, President Trump clearly signaled a willingness to hold off and wait for Iran's response over the coming days.
Right, so the immediate threat of military escalation was paused.
And just to add another layer of relief for global trade, late Tuesday evening Eastern Time, the European Union and the U.S. reached a provisional agreement to cut industrial tariffs.
Which is a massive sigh of relief for global supply chains, because tariffs create severe supply chain friction, which directly translates into higher prices for consumers.
Yeah. So when you combine those provisional tariff cuts with the diplomatic thaw in the Middle East, that massive inflation fever dream gripping global markets heading into the U.S. Open was suddenly broken.
It completely rewrote the narrative for the day. Let's take a quick break, and then we will dive into how the U.S. session actually played out.
All right, we are back, which brings us naturally to our second major question. Session 2. What moved markets during U.S. trading hours?
A massive, sweeping intraday reversal. I mean, if you look at U.S. equities, the algorithms and early traders were still digesting that overseas anxiety early on.
Yeah, causing S&P 500 futures to bottom out early at 7,364.
But once the opening bell rang in New York, and the reality of that diplomatic news started really getting priced in, the market just surged aggressively to peak near 7,451.75.
And the bond market immediately validated that equity rally. The 10-year Treasury yield dropped from the prior day's 4.667% all the way down to 4.572%. Wow. Yeah, when investors see inflation fears subsiding, they rush to buy bonds, right? Which pushes bond prices up and yields down. But, Mira, we really need to talk about the energy market today.
Oh, absolutely, because to me, it looks like a glaring anomaly. It was the single most fascinating dislocation on the board.
Right.
Crude oil, specifically WTI, plunged over 5.6% to settle at $98.26 a barrel.
Okay, wait, help me understand that, because we had incredibly bullish physical data over the last 24 hours.
Yeah, we did.
On Tuesday, we saw an unexpected 9.1 million barrel drop in API crude stocks, and then Wednesday morning at 10:41 a.m. Eastern Time, we get a report of a record drawdown in the Strategic Petroleum Reserve.
Right.
So if the physical barrels are literally missing from the vaults, how can traders just ignore that? Doesn't physical reality eventually override a diplomatic promise?
Well, it does eventually, but you really have to separate the physical spot market from the financial futures market here.
Okay, how so?
So the physical reality of the market is screaming that supply is incredibly tight right now. But a crude oil futures contract isn't just pricing what is happening today.
Right, it is looking ahead.
Exactly. It is pricing the trajectory of supply 6 to 12 months out. Traders looked past the empty barrels today and priced in that diplomatic off-ramp instead.
Oh, I see. They are betting that the Strait of Hormuz will be flowing freely in the near future.
Yes, which completely destroys the geopolitical risk premium that was propping oil prices up in the first place.
So they are essentially looking straight through the windshield while the data is in the rearview mirror.
That is the perfect way to look at it. And that same dynamic explains the most glaring contradiction of the day.
You mean the Fed minutes?
Exactly.
Yeah.
At 2 p.m. Eastern Time, the Federal Open Market Committee released their meeting minutes.
Yeah.
And they were highly hawkish.
Extremely hawkish. I mean, Fed officials explicitly signaled a willingness to keep rates higher for longer if inflation stays elevated. And they specifically cited the Middle East energy shocks as a primary reason for maintaining that restrictive stance. Now, normally, we talk about discount rates acting as valuation gravity.
Right, like interest rates are gravity for tech stocks.
Exactly. When the Fed threatens higher rates, it increases the weight on future earnings, pulling those sky-high tech valuations back down to earth. That is why today's tech rally was so surprising at first glance.
The market basically laughed off the Fed minutes.
But why?
Because the market recognized that the FOMC minutes were completely stale by the time they hit the tape.
Oh, right, because they are a summary of a meeting from weeks ago.
Exactly. The real-time drop in oil prices happening on the trading floor today was actively solving the exact inflation problem the Fed was worried about in those backward-looking notes.
So the market saw crude plunging 5% and just decided the Fed's fears were suddenly outdated.
Precisely. The algorithm saw the oil plunge, discounted the Fed minutes as old news, and just hit the buy button on equities.
Wow. Okay, so that covers our intraday action. Forward-looking geopolitical relief entirely eclipsed the backward-looking central bank minutes.
Absolutely. Let's take another quick breather before we get into the corporate side of things.
And we are back. Let's move into our final major question of the day, Session 3, Corporate Events Recap and What to Watch Next.
So if geopolitical relief was the spark that ignited the rally today, the fundamental anchor of this market remains totally unchanged.
The AI capital expenditure boom.
Exactly. We are watching an AI CapEx cycle-agnostic arms race play out. Regardless of what the broader economy is doing, these mega-cap companies are locked in a spending war to build out their artificial intelligence infrastructure.
And we had multiple corporate catalysts confirming that reality today. First, you have ASML.
Oh, yeah.
Their CEO stated publicly that strong AI demand will keep chips in a supply-limited market for the foreseeable future.
ASML is so critical here. If you are holding tech stocks right now, you really have to understand their role. ASML and Taiwan aren't just manufacturers.
Right.
They are the single, unbypassable toll booth on the highway to this trillion-dollar AI future. ASML makes the extreme ultraviolet lithography machines, which the only machines in the world capable of printing the most advanced AI chips.
So it doesn't matter how fast software companies want to move. They still have to pass through that specific manufacturing gate.
Exactly.
And the big tech players are lining up at that toll booth with dump trucks full of cash.
Literally.
At 3:33 p.m. Eastern Time today, Google announced a massive $15 billion data center infrastructure investment in Missouri.
$15 billion. That is not an experimental research budget. That is the foundational physical plumbing, the land, the cooling systems, the power grids for the next decade of software.
And on the software side, the numbers are getting even more staggering. Around midday Eastern Time, reports surfaced that OpenAI is laying the groundwork for an IPO as early as September.
Targeting a massive $1 trillion valuation.
$1 trillion. But if you look closely, there is a massive collision brewing between the private sector's ambition and the public sector's regulatory brakes.
Oh, for sure. Contrast OpenAI's $1 trillion valuation target with the new framework the U.S. government just rolled out today.
Right, the one requiring AI labs to share their foundation models 90 days before release.
Yeah. That introduces serious regulatory friction into an industry that measures progress in weeks, not months.
But for today, the equity market remained hyper-focused on the hardware layer. NVIDIA reported its Q1 earnings after the closing bell, shortly after 4:20 p.m. Eastern Time.
And a key takeaway there was their explicit confirmation that no data center Hopper products are being shipped to China.
Right, strictly adhering to U.S. export controls. Which actually brings us back to that physical bottleneck we mentioned earlier.
Yeah.
We have to contextualize this massive hardware boom with the geopolitical reality on the ground, specifically the recent inauguration of Taiwan's new president.
The broader market is deeply intertwined with that event. The recent assertion of Taiwanese sovereignty, followed by sharp rebukes from China, matters to a U.S. equity investor precisely because Taiwan is the physical choke point for all this AI silicon.
Exactly. If that geopolitical tension flares into actual conflict or blockades, the entire AI infrastructure cycle is at immediate risk.
The hardware simply doesn't exist without that specific geographic manufacturing base.
It really puts the volatility of the entire day into perspective. You have trillion-dollar software dreams completely reliant on a fragile supply chain sitting on a geopolitical fault line.
It's wild.
In fact, it reminds me of a joke I saw floating around the trading desk today. Let me just read this to you exactly as it was written.
Okay, let's hear it.
Well, folks, they say a watched pot never boils, but a watched Strait of Hormuz apparently drains the oil market by over 5% in a single afternoon.
Huh.
We started the day sweating over hawkish Fed minutes and sticky inflation, but then rumors of a U.S.-Iran peace deal broke out, and suddenly traders were dumping crude faster than you can say OpenAI $1 trillion IPO.
So true.
If only Jerome Powell could use ChatGPT to write a dovish policy statement, we'd be at Dow 100,000 by Friday. So whether you rode the tech rally to victory or got caught holding the bag despite massive oil inventory drawdowns, take a deep breath and log off for the day. Just remember, in this market, the only thing more volatile than geopolitics is an AI chip stock heading into earnings.
I love that. It captures the mood of the floor perfectly.
Yeah.
The informational whiplash today was just incredible.
Truly. So what does this all mean for tomorrow? Here is what you need to watch next on Thursday, May 21st.
At 8:30 a.m. Eastern Time, we get initial jobless claims and April new residential construction.
Also at 8:30 a.m. Eastern Time, the Philadelphia Fed Manufacturing Index drops.
Then at 9:45 a.m. Eastern Time, we will see the S&P Global Flash US PMI composite giving us a read on purchasing managers' sentiment.
Right. At 10 a.m. Eastern Time, look out for the Census Advanced Quarterly Services Report for Q1 2026.
And finally, at 1 p.m. Eastern Time, there is a Treasury 10-year TIPS reopening auction.
That TPS auction, Treasury inflation-protected securities, will be a fantastic real-time gauge of where institutional inflation expectations actually sit after today's massive oil plunge.
Absolutely.
Now, before we close out the show, it is time to put our money where our mouth is, at least hypothetically, with our bonus on-air session, paper trading.
Yes. We run this 2-minute segment to see if our daily macro analysis actually generates alpha or if it is just noise. We launched this internally on April 17th with a starting portfolio of $10,000.
And as of today's close, the portfolio is sitting at $10,948.97. That is a 9.49% return.
Which is outperforming the S&P 500's 4.31% return over that exact same period.
Not bad for a daily news digest. So what is your move for tomorrow's close? Actually, let me start.
Go for it.
So we are sitting on a massive 35.8% allocation to the energy sector right now. And with the U.S. and Iran actively negotiating this resolution, the geopolitical risk premium that has been inflating oil prices is evaporating fast.
Very fast.
We are severely overexposed to this unwinding narrative. If this peace deal goes through, that premium vanishes overnight. So I am deciding to sell $1,090 of our XLE Energy ETF position to lock in those profits before the ink dries on that treaty.
Makes sense.
And I want to rotate that capital, buying $1,090 of XLK, the technology sector ETF.
I see the pivot. Trimming the geopolitical risk and moving into structural growth.
Exactly. Rotating into technology allows us to ride the tailwinds of the AI capex boom we discussed today. Google's $15 billion spend, ASML's supply constraints, and OpenAI's massive IPO ambitions, they all validate that this is the strongest growth narrative in the market right now. What about you?
Well, I am on the exact same page regarding that rotation.
Really?
Yeah. For my portion of the portfolio, I'm going to sell $1,000 of XLE and buy $1,000 of XLK.
Nice.
Trimming XLE right now just makes fundamental sense to reduce our concentrated downside risk if a peace agreement is formally signed. And on the flip side, XLK offers the absolute strongest fundamental growth offset to the Fed's higher for longer valuation gravity.
Perfect. So, combining our decisions, the aggregated trades to be executed at the close of Thursday, May 21st are sell $1,045 of XLE and buy $1,045 of XLK.
And of course, the mandatory disclaimer. This is a paper trading experiment for educational purposes only. It is not financial advice. Past performance does not guarantee future returns, and you should absolutely not copy these trades.
We are just testing our own theories in real time.
But stepping back, all of this leaves us with a fascinating collision to think about.
Oh, definitely.
We are watching software companies like OpenAI target trillion-dollar valuations, pushing the absolute physical limits of hardware and silicon. Yet, at the exact same time, the U.S. government is quietly building 90-day regulatory speed bumps for releasing these new models.
Right. It raises a really critical question for the long-term tech cycle. As billions of dollars continue to pour into these data centers, will the ultimate bottleneck for the AI revolution actually be the physical limits of silicon, or will it be the speed of bureaucratic compliance?
That is something you definitely need to mull over as you watch these tech multiples stretch.
Please share your thoughts on today's massive intraday reversal and whether you think the AI bottleneck will be hardware or regulation down in the comments below. See you next time.